just making a series of job cost records isn't going to put your books in adequate order. You have to do the normal steps in the accounting cycle, starting with recording all of your transactions and events for the period to journal entries. Wilson Brothers, we saw the job cost record for job ABC002, but that's not going to be the only job they have during the period. So for the sake of simplicity here, we're going to record all job costs in one collective journal entry. We're going to do so retroactively when the period ends. So going back into our books and setting our books up for the month, we're going to see that on February 1st, Wilson Brothers purchased $89,000 worth of direct materials on account. Let's take it back to financial accounting here and do the 5 steps to recording a journal entry. What 2 accounts are going to be affected in here? What are we buying and how are we paying for it? We're buying a bunch of direct materials, which we're going to book under raw materials inventory. And we're paying on account, so to put that debt that we have now to our vendors on our books, we're going to use our accounts payable account. Raw materials inventory is something we're going to use to eventually make revenue in the future, therefore it is an asset. Accounts payable, we owe something to somebody else, that's a liability. Are they increasing or decreasing? The amount of raw materials, direct materials that we're going to have sitting in our storage facility after we make this purchase is going up, so we need to increase that account. And the debt that we have this particular vendor is also going to be increasing, so we need to increase that account as well. According to the rules of the double entry system, when an asset goes up, it goes up on the debit side, and when a liability goes up, it goes up on the credit side. So our journal entry in this specific instance on February 1st is to debit raw materials inventory for the $89,000 purchase cost and credit accounts payable for that same amount in the journal entry to record the purchase of direct materials on account. And after we had those materials in storage, we used them during production. So let's make the journal entry that we would have to account for the amount of materials taken out of our storage facility and used in production across all of our jobs. Our records indicate that Wilson Brothers used $81,000 worth of direct materials and $4,000 worth of indirect materials during the period. We're going to have three accounts be affected here. We're taking these materials out of storage and putting them into jobs which we are in the process of completing at this time. And the account that tracks the cost that's been put into jobs which you are currently working on is your WIP inventory account. That's where our direct material costs are going to go, because we can trace those to those jobs via those requisition forms. But those indirect materials we don't trace. Those are indirect costs which we've chosen to pool up into an accumulated pool full of indirect costs, which we call manufacturing overhead, so we're going to have to use that account. But all of these materials came out of storage, and in storage, when they're sitting there just waiting around to be used, they are raw materials inventory. So our three accounts being affected here are WIP, manufacturing overhead, and raw materials. What type of accounts are these? Well, any account that ends in the word inventory is going to be an asset. Manufacturing overhead is a transitional account, and raw materials inventory, also an asset. Are they increasing or decreasing? Well, these costs are going into WIP. We're recording them on our job cost records as they go. And the amount of costs that are going to be contained on those job cost records is going to go up each and every single time that we requisition materials. So WIP inventory has to be going up. Manufacturing overhead as a transitional account doesn't really go up or down in any case. Transitional accounts exist for one purpose and one purpose only, to do their job. In this case, manufacturing overhead's job is to accumulate all of those costs and be there when you spread the costs out of that pool to all the different jobs. So it has a little bit different rules than up or down, if you will. We'll get to that in a second. If the amount of costs in our WIP inventory account is going up because it tracks how much cost for materials we have already accounted for that we are using in jobs, the amount that has to be in raw materials has to be going down, because those materials are coming out of storage and going into jobs that we are working on. So asset accounts go up on the debit side. What do we do with this transitional account? What do we do with manufacturing overhead? Well, the rule for manufacturing overhead is pretty simple. Costs go into the pool on the debit side, they come out of the pool on the credit side. Or if you want more accounting verbiage, actual costs are recorded on the debit side. Allocation from the pool to jobs occurs on the credit side. This is an actual cost. We had to actually pay for all these indirect materials, which means we're building up the pool, and the pool builds up on the debit side, so we're going to debit manufacturing overhead. Raw materials inventory is an asset going down, is going to go down like all assets do on the credit side. So here, at the end of February, our journal entry to account for all of the materials taken out of storage and put into use on jobs, be they direct materials or indirect materials, is going to start with a debit to WIP inventory for the amount of direct materials that we use during production, the stuff we could trace directly to jobs, and that was $81,000. We're going to have a second debit to manufacturing overhead to pull up the cost of all those indirect materials we're using across all our jobs that we're not directly tracing, and that would be $4,000. But since raw materials inventory is inclusive of direct materials and indirect materials, the whole balance has to come out of raw materials inventory, so we're going to credit raw materials inventory for the full $85,000 to make our debits equal our credits in the journal entry to account for the fact that we use raw materials during the production process. That's one cost component down. Now we got to account for the second direct traceable cost component. Well, not necessarily traceable, but some of it is, which is labor. And labor costs during the period for Wilson Brothers were $39,000 for direct labor payroll, the people actually sitting there building houses and sheds and what have you, and $15,000 for indirect labor payroll, the people that supported our carpenters but don't actually physically build the goods. All this is being paid in cash. So what accounts are going to be affected? Well, are we going to have like a salaries expense? And the answer to that is no, because all of the labor functions we have here are necessary for production. You have to pay carpenters to make homes or sheds. You have to pay their support staff, again, custodial or supervising on the production floor, in order to have an efficient workplace. That's necessary for production as well. So there's no salaries expense being recorded here. All of these costs are inventoriable, so they're going to go into WIP if they're direct, or if they're indirect, they're going to go into that same pool, manufacturing overhead. We're paying all of this in cash, so the third account being affected is cash. What type of accounts do we have here? WIP is an asset, manufacturing overhead, we just saw, transitional, and cash is also an asset. The amount of costs being contained in our WIP account being recorded across all our job cost records has to go up because we're assigning all these labor costs to jobs. The amount of cash that we have on hand, however, since we have to pay this expense to all our laborers, has to be going down. Like all asset accounts here, WIP's going up and assets go up on the debit side. This is an actual cost going into the pool, and the rules of this manufacturing overhead transitional account say that actual costs going into the pool go in on the debit side, and cash in this case has to be the credits because it's an asset going down. So the journal entry to account for direct labor during the period is that on February 28th we are going to debit WIP again just for the direct cost, so just the $39,000 of direct labor payroll, because that's all getting traced to the separate job cost records. The indirect cost that we have has to be pulled up in our manufacturing overhead pool, but it's going to be a debit to manufacturing overhead for the other $15,000. And since we have to pay for all of this, the credit to cash is going to be for whatever makes our debits equal our credits. That is $54,000 in our journal entry to record our labor costs for the period. We've got costs going into the pool during the period that need to get spread out amongst different jobs, and we're going to do so making our best estimate. And per our best estimate, we decided, based upon all of our predetermined overhead allocation rates and our estimated quantity of the driver and the actual amount of the driver that we use across all our jobs, we're going to spread out $80,000. Well, that cost is still a production cost. It's still inventoriable. It still has to go into your WIP inventory account. These costs are coming out of our manufacturing overhead pool. So those are the two accounts that have to be affected. WIP is an asset. Manufacturing overhead is transitional. More costs are going into WIP, so that account has to increase. And like all assets, it's going to increase on the debit side. Since every journal entry needs a debit and a credit, we know that manufacturing overhead has to be our credit. But again, why is it being credited? Because the rules for manufacturing overhead state that costs come into the pool on the debit side, but in this case, costs go out of the pool on the credit side. So the journal entry to allocate indirect costs from our manufacturing overhead pool to all our various WIP inventory that we're working on is that on February 28th, we debit WIP for the $80,000 we're allocating, putting into the cost of all of our jobs that are in process, and taking it out of manufacturing overhead by crediting that for the same $80,000 in the journal entry to record the allocation of indirect costs to our jobs during the period. Jobs are going to be completed during the period. That's what we want to do. We sell completed jobs, so we need to transfer all of the costs that were being recorded in jobs that were in process out of work in process when they're no longer being worked on. Well, if they're no longer being worked on, what are they? They're a finished good. So one of our accounts is going to be finished goods inventory. The other account that's being affected is we no longer have as many jobs that are in process with inventory. Both end with the inventory, so we know they're both asset accounts. The amount of costs being contained in WIP inventory, or not, in finished goods inventory, which is inventory that is finished but has not yet been sold, has to be going up. And since those jobs that we finished are no longer a work in process, WIP inventory has to be going down. And assets go up on the debit side and down on the credit side. So our February 28th entry to record the completion of $188,000 worth of jobs is going to be a debit to finished goods inventory for the amount of jobs being completed, total cost of jobs being completed, which was $188,000, and a credit to WIP for that same $188,000 in the journal entry to record jobs completed during this month of February. In our next journal entry, we have that Wilson Brothers is going to pay $15,000 in customer service expenses and $45,000 for advertising. Do these costs go into WIP? And the answer to that is no, because these are not directly related to production. Customer service is helping customers with any problems they're having with the products that we sold to them previously after we made the sale, but that's not related to production. Advertising is probably necessary to make sales, but it's not related to production, which means since these costs are not related to the production process, they're not product costs. They can't be inventoried. They are period costs. They are part of our operations aside from the production process, which means we're going to expense these under each respective expense account for customer service expense and advertising expense. We are paying for these expenses in cash, so that's the third account being affected. Customer service expense and advertising expense, pretty dead giveaway that their account types are expense accounts. Cash, as you already know, is an asset. Are they increasing or decreasing? Well, expense accounts track how much we paid for some certain component necessary cost of our business. So the total amount that we will have paid for customer service is going up. The total amount we have paid for advertising is going up. And since we have to pay this, the amount of cash we have is going down. Expense accounts, per the rules of the double entry system, go up on the debit side, and assets go down on the credit side. So our February 28th journal entry to account for our period costs is going to be a debit to customer service expense for the $15,000 we paid people that do that function, a debit to advertising expense for the $45,000 that we paid for advertising, and a credit to cash for the total amount that we had to pay for all of these non-inventorial period costs. And this is how we record the journal entry to account for the period costs that we paid for customer service and advertising. We don't want to just finish stuff. After we finish stuff, we want to sell it. So how do you account for the sale? Well, sale, taking you back to financial accounting here, the sale of inventory always results in two entries being made. One records the revenues, the other one records the expense. Let's start with the one to record the revenues. During February, Wilson Brothers sold goods at a market value of $270,000. Let's just focus on that part for right now. Let's account for the sale portion of this. We sold these on account. So what two accounts are being affected? Well, now we're owed more money for the sales that we made. So our accounts receivable account has to be affected. We sold this stuff, which is the function of our business that we do to generate revenue. So sales revenue has to be the other account being affected. Accounts receivable is something that's going to be converted to cash eventually, is by definition an asset. And sales revenue is our revenue account. The amount of money owed to Wilson Brothers after we made these sales and billed people that bought these goods from us has to be going up, and sales revenue tracks how much sales we made during the period. Well, we just sold more goods. That also has to be going up. And assets go up on the debit side, while revenues go up on the credit side. So our journal entry to record the revenue portion of our February sales is on February 28th. We debit accounts receivable for $270,000. We credit sales revenue for that same amount of money in our journal entry to record February's credit sales. The second entry for when you make sales records the expense. Basically, you've been inventorying all of these costs that you can inventory, all of your product costs, all the costs necessary for production, because the rules state that you can't actually expense those costs until you sell the inventory. Well, we just sold it, so now we need a second journal entry that's going to record the expense. We sold goods that cost us money. COGS, cost of goods sold, is definitely being affected here. That's the account that we eventually get to expense all of our production costs in. We're going to have a higher cost recognized for goods that we actually sold, and those goods that we actually sold were on our books sitting there in finished goods inventory. So finished goods inventory is the other account that's being affected. COGS is an expense account. All inventory accounts are asset accounts. COGS tracks how much we paid for goods that we sold during the period. But we sold more product, which means that account has to be going up. Finished goods inventory keeps account of what amount of cost we have committed to inventory which we've finished but not yet sold. Well, this inventory is no longer not yet sold. It has been sold. So the amount that we're keeping in finished goods inventory has to be going down. Expense accounts go up with a debit. Asset accounts go down with a credit. So this journal entry on February 28th to record our expenses related to production of goods that we actually sold during the period is a debit to COGS for the $180,000 cost basis. That was our end. That's how much we paid to manufacture these goods. Yes, we turned around and we sold them for $270,000, but you don't expense at sales value. You expense at your production, like how much you had to pay for production of those goods that you later sold. So we debit COGS for $180,000. We credit finished goods inventory for $180,000 when we recorded February's cost of goods sold. And then, like I said, timing is not always the nicest thing. Sometimes you will have indirect costs that occur during the period that you didn't know what the actual amount was going to be until way after you'd sold something before. Well, we still need to account for all those indirect costs when we actually know what they cost. So what actual indirect costs did Wilson Brothers have during this period? They had $18,000 worth of depreciation on the equipment they used for production, and they paid the following overhead expenditures in cash. They paid $44,000 in supervisor salaries. They paid plant utilities of $10,000. They paid $2,000 for repairs and maintenance on their plant, and they paid $1,000 for insurance. What accounts are being affected here? Well, firstly, manufacturing overheads being affected. Like I said, costs go into the pool on the debit side. Costs are going into the pool right here. These are actual costs that we need to put into our pool. What other things are being affected? Well, we got two components here. Firstly, depreciation is a non-cash expense. Depreciation is recorded in a separate account called accumulated depreciation. And then cash is going to be the other account because we paid for all those other things in cash during February. What type of accounts do we have? Manufacturing overhead, still transitional. Accumulated depreciation is an asset account, but it decreases the value of an asset, the machinery that's being depreciated. It's a contra asset. And cash is an asset. That contra asset account, the total amount of value that our equipment has lost because we've been using it, and our building has lost because it's getting older, is going up. Since we paid all of those expenditures for supervisor salaries, utilities, repairs and maintenance, and insurance in cash, the amount of cash we have has to be going down. Again, these are actual costs. Actual costs go into the manufacturing overhead pool on the debit side. Contra assets are asset accounts, but they work the opposite way. So since normal assets go up on the debit side, contra assets go up on the credit side. And cash is a normal asset, goes down on the credit side. So on February 28th, when we record our actual expenditures, we're going to have a debit to manufacturing overhead for the total amount of all of these costs that we have above us, which adds up to $75,000. We're going to credit accumulated depreciation for the $18,000 of accumulated depreciation we experienced during the period. And we're going to credit cash for the total of all of the indirect costs to be paid in cash during the period, which is our $44,000 of salaries, plus our $10,000 of utilities, plus the $2,000 of maintenance, plus the $1,000 of insurance expense. That all totals up to $57,000, which makes our debits equal our credits in the journal entry to record the actual overhead expenditures we had during the period. And at this point, Wilson Brothers has a problem. The problem is that in our 3 journal entries, when we recorded actual overhead costs, we had $4,000 of indirect materials, $15,000 of indirect labor. Those are still actual. You actually have to buy those materials. You actually have to actually pay your support staff. And then we had $75,000 of other actual indirect costs. If you total those 3 numbers up, that's $94,000. Well, earlier we made an estimate based upon our normal costing system, our best guess of what overhead will be based upon what it normally costs us, and we decided to put $80,000 into jobs. Well, $80,000 isn't $94,000. In this case, all of this inventory that's been flowing through our inventory accounts from raw materials into WIP, into finished goods, and eventually into COGS has been doing so at a cost below what it should have been because we underallocated or guessed too low on our overhead by $14,000. Happens every period. Now what we need to do is we need to fix it, which I'm going to cover in the next video.